We did last week say goodbye to our oldest son, who has decided to go on a 2-year church mission.
30-year borrower over the life of the loan, $400,000, would roughly pay $483,000 of interest. When it goes to 50, it basically doubles. It is closer to $980,000.
His scenario is a $421,000 purchase price, financing $400,000. At the end of 10 years, basically $50,000 less in equity on the 50-year mortgage than it would be on the 30-year mortgage.
Trump then and Scott Bessent are now out saying, we are going to refund tariffs to all U.S. citizens making less than $100,000 a year. Episode 65 of Market Moves with Mark and Jeff, two uninteresting guys talking about interesting times. Jeff, we were very excited to attend the Resi Club conference, small conference. I think it's kind of small, held in New York last Friday. We had tickets. We were going. Really, the government shutdown more than anything affected what we were doing. So we weren't able to make it. But I know they were covering the relative sickness that is here in the housing market and what we've been living through and covering on this podcast for 3 years now. I'm excited to talk to you today about a lot of different steps that the government is trying to, at least considering, to address that. But before, government shutdown or not, what's going on in your world?
Yeah, good question. Well, I think just to underscore the lack of interest that you and I project, we don't even have different colored shirts on today, Mark, which was not an intentional thing. When I saw you, I was like, oh crap, we're about as uninteresting as possible. So at least we're true to the brand, if nothing else. And on that topic, I don't really have much interesting in my life, although we did last week say goodbye to our oldest son, who has decided to go on a 2-year church mission. And so, kind of an interesting, situation where, decides to do it, kind of preps for it, takes months to get everything, just in order and ready to go. And then, last Wednesday, we found ourselves in the parking lot, like ushering him out and saying goodbye. And off he goes with 2 suitcases for what we know will be 2 years. He'll be in Jacksonville, Florida, here in the next week or so. I went through that same experience, when I was 19 years old. I went and spent 2 years in Argentina, in Buenos Aires, which, by the way, it's always hard. Like, I'm not a great Spanish speaker at this point, but it's hard to say the name without the Spanish accent. It doesn't sound right. And yet I feel weird, like having that be the only accent that I get right. But anyway, so I'm 19 years old, ready to go off on this big adventure. A lot of fun. My mom's in tears, and the family's emotional. And as the one leaving, it seems to resonate a little bit differently than the family that's back behind. But cool experience. We're excited to see how it goes for him. I think it's really good to get out and live and be on your own. I'm sure you went through a similar thing going to college or whatever. It's just that first major foray out of the house, and kind of fun to see it from this angle as opposed to just having lived it as the one leaving.
Well, I knew you were going through that, Jeff, last week, how your family was, and I was hoping you'd bring it up on the pod. What a cool and emotional time for sure. I'm sure a proud moment. I remember, even for me, being pretty emotional leaving for college, just kind of moving out of the house. I remember my parents sort of following me behind. So they sort of walked me onto campus. And then I was 2.5 hours away. So it was easy to get back. I could come back whenever. A little bit different deal with this mission assignment, isn't it?
Yeah, it really is. I mean, you're out there. And when I went, the internet was there, but not nearly as like broadly adopted and ubiquitous. Today, you can have a weekly Zoom call, with your kid that's out there and kind of see how things are going and stuff. But man, when I was in Argentina, it was, you wrote a letter and put it in the mail, and it took 3 or 4 weeks to get from their mail system to, the family's inbox at home. And then they'd get it and respond and send it back. And that was another 3 or 4 week delay. And so like the communication was a month and a half delayed. By the time I sent something to them, they responded it and I got it back. And just, vastly different from the email and kind of the instant communication world that we live in today. But all the same, like they go out and, unless there's some health or other issue that comes up, it's kind of known it's going to be 2 years before you're back home, and you just learn and grow and have so many valuable, just wonderful experiences, out there doing it. But there's a lot of challenges too. I mean, it's service oriented, teaching, oriented, but it's a lot of work and stuff. But I'm really excited for the experiences I know he'll have. He's to a point in life where he's ready, ready for it. And we all get there, right? Like it's time to, leave the nest one way or the other.
Well, we're going through college application and selection process with my daughter, who's a senior, just finished up senior homecoming right now. And we've talked a little bit about this on the podcast, Jeff. I'm unsettled in my perspective on the education system and how we go through this. I think my daughter has a track that works really well for her. She wants to be a nurse, and I think college is great for that. But I'm working through my kids in elementary school right now, and it's a really good experience. But I just can't help but think how wasted a lot of their day is. That they really, if you consolidated all the actual learning that's taking place, academic sort of learning, not socialization, but academic learning, it's I don't know, an hour tops a day, probably, out of the 8 or 9 hour day that they spend there. And we're working through with my youngest son, who's 6, and man, he's just the opposite of my wife and I, and my daughter and my 9-year-old son, where he could care less about the right answers. We can't get him to finish assignments because he's trying to do whatever he's working on perfect, whatever he cares about. And like, we almost find ourselves trying to beat that out of him on some level so that he can get a good grade. And I am certain that is not the right thing to do. And so I'm sounding like a homeschooler more and more. I'm not saying that I'm doing that. I'm probably not, but I just, a certainty that a system that really was the best we had for a century is probably no longer the best we have. There are better options out there. And because human beings are creatures of habit, it's just disruptive to think about something different. But there's a lot of tools out there that give optionality, internet, artificial intelligence, and all those things. So I'm constantly thinking about it.
Well, it was a really fun conversation that we had with Roy Meyer, who was on, talking a little bit about artificial intelligence and alternative approaches to education in different countries where he's been and his kids have had exposure, right? And there really are just a lot of different options and opportunities today that probably didn't fit previously. But I've heard, and I wish I could remember the book offhand, I don't, but I've heard the perspective shared that in school, like you're kind of programmed not to fail. It's exactly what you're talking about with your son. You got to get the A, got to do it exactly right if you want to get the grades that then lead to the next thing and the next thing. But when you're in the real world, especially if you're on like an entrepreneurial track or something, it's kind of a fail fast mentality. It's like, you don't have to get the A. In fact, you're probably not going to get the A, equivalent in the product that you're trying to bring to market. It's just get something that's workable and then refine and iterate. And that's not the reinforcement mechanism that you get in a traditional education and grading system. And some kids care a lot more than others. And some of my kids are much more focused on getting the good grades, and others are much, less so. And so there's really not this one size fits all, but I'm seeing more options and opportunities with charter schools. One of our boys is in a career tech, it's an oriented, you got a bunch of different tracks, but he's on a medical track. And so, he's doing stuff that he's more interested in and just seems to be at least better than what it has been in terms of, fields of study. Now there's still the traditional grading and that sort of thing. Probably something we could talk about for, a lot longer than we need to, but it's interesting to think, what is really in their best interest to set them up to be successful as they move, outside of a high school environment.
Yeah. There is a definite path to get ahead, to pour into something that you are passionate about, and instead of being this generalist that sort of meets the average, and I don't want to knock that out of my younger son. So trying to think through it, and I think this ironic position, I think, as I am touring colleges and whatnot. I mean, there's their acknowledgement of the landscape changing with artificial intelligence is pretty underwhelming, and you can see that it's sort of against their incentive structure to push that, because I do think it is ultimately a replacement on some level. And we've got like the Palantir company that's has come out this year, I think, and said, hey, we're not hiring from colleges specifically. We've got other ways to find the people that are important. And I think you're going to get more of that because there's just more optionality, and you're looking for the best that are the best prepared to contribute and add value.
Yeah, absolutely. And it isn't necessarily just those that went to the right school and graduated top of their class and that sort of thing. And so, so much of this is facilitated by technology, and I think the desire to evolve and move forward. And so it's really interesting to be living it. Yeah, and I think it applies, to most, to a lot of business operations too. I mean, disruption is a way of life. We've talked about, evolution. The ones that survive are the most adaptable, not the strongest or the smartest. And to the extent that people learn that lesson, whether in school or once they get out of it, really paves the way for their ultimate success. And I think we see that in real estate. I think we see that in appraisal, and on and on. It's not just an academic, challenge or reality, but, a lot of interesting things on that front for sure.
Well, best wishes to your son and your family on the mission trip. Good to hear a little bit about it.
I appreciate it.
Yeah. Well, Jeff, the housing market is in the ICU and has been in this intensive care unit for well more than a year. We have been talking about rates dropping, which we certainly need and want. The certainty of the interest rate landscape over the foreseeable future. We need certainty there. But we've also talked about the least affordable housing market that we've seen in a really long time. And that the housing market is inaccessible to the majority of Americans. And by evidence of what we talked about in the last episode, which was the average age from 29 to 40. Now, the average age is 40 years old for first-time home buyers. It's just not accessible to the younger folks. And Fannie and Freddie, FHFA, know this. Trump knows this. I think it's has been sort of one of the pillars of their campaign and presidency, and it isn't fixed. And in fact, it's worse, I think, today than it has been. And so we've got some bold suggestions over the last week. Thought we'd go through them a little bit and share our perspective on them.
Yeah, absolutely. I think the one that stood out the most was the floating of this trial balloon, or this idea of, okay, what if we just make a 50-year mortgage available to people? With the idea being addressing the pain point, which is the monthly, mortgage payment as a result. And on its face, it's interesting regardless. It sounds like, hey, a 30-year mortgage is more affordable than a 15-year mortgage in terms of the monthly payment. So why not extend it out further to get the same effect? But as we've dug into it, I don't think it's not likely to have nearly the impact that might be expected as far as addressing the affordability. One of the things that just really stood out to me, I think, from our conversation with Ed Pinto is he said, most government programs are really good at stimulating the demand side of the economic equation, much less so the supply side. And this is really one of those, it seems, ideas that, well, we can make it easier for people to pay, the same amount for the housing that's probably just not affordable, in part because of the price levels, by spreading out or stretching out the term or whatever. But I think we're seeing some resistance to the idea as to how affordable that's actually going to be.
Yeah, there's plenty of negative, and we'll talk about that here today. The enormous amount of additional interest that would be paid over the life of a 50-year loan. I do think that on some level, we've talked a lot about this cruel experiment that federal monetary policy over the last 2.5 decades is playing on the home buyer psyche or homeowner psyche these days. I mean, it's ugly and hard to predict. We've created a monster on some level, and you don't really know what that monster is yet. I mean, it's yet to reveal itself, other than just sit on the fence and not do anything. And how long can we hold on that decision? And I think the answer is, in current condition, as long as we need to. I'll stay in this house until I don't need a house anymore. It seems like what the market is doing. But so to the extent that some headlines and initiatives can speak to buyer sentiment and buyer optimism or create some optimism. I think that something like this at least gives a tool to folks, whether they use it or not, to maybe make a deal work that they wouldn't have been able to make work otherwise. And there are some positives to home ownership, regardless of the rate that you're in, if you're in an appreciating market, and a few other things there. So I don't know where you come out on that, Jeff, but I do think there's a little less talked about positives that come with these trial balloons floated.
Yeah, and I think you framed it well, Mark, when describing it as, essentially an alternative to an interest-only loan, or like an ARM that has an adjustable rate at a set, point in time. It is an avenue. It would be another option on the table. And I think it's worth stating, to my knowledge, there is not the option to get a 50-year mortgage today, but Bill Pulte, the director of FHFA, has floated the idea, saying that Fannie and Freddie are working on it. My guess is it will come to market. Now, whether it's adopted or not, remains to be seen. But it's more stable in the sense that it locks in an interest rate, than what an adjustable rate would be, or if you got into an interest-only, mortgage. Before the last, real estate crash and the great financial crisis, part of the problem was these risky loans, but they were interest-only loans where you weren't actually paying down any principal, and people were, lining up to get those because it was the same kind of mentality. Affordability is hard. This is the only way I can get in. If I don't get in now, I'm going to miss out, never be able to. At least with the fixed rate, you're locked in for an extended period of time. And we'll look at some of the effects or the differences between a 15, a 30, and a 50-year mortgage as far as interest rates, amount of interest paid over time, and that sort of a thing. I think you make a really good point. It's not all negatives. I don't think that a 50-year mortgage is as attractive as a 30 or a 15. And you talked about the real estate market being in the ICU. One of our mutual friends, Frank, sent us an image of Dave Ramsey, fictional, of course, but, fictionally in the ICU when he hears the idea of a 50-year mortgage floated, because he's saying, hey, only do a 15-year, don't do a 30-year, have a 20% down payment, get it paid off as quickly as you can is his whole mantra, right? And so it was kind of a comical, image of him, going into cardiac arrest at the idea of a 50-year mortgage even being taken seriously. But I think it will provide an opportunity for some market participants that might be the right fit. We'll see how many it actually is the right fit for in the long run, though.
Yeah. So Jeff, I've added a slide to our show slides as the first one. So it wasn't just Bill Pulte that announced this concept. It was this graphic that Trump had Truth Socialed, however you say that. Of course, calling himself a great American president, along with President Roosevelt, who had announced the 30-year mortgage and had put the 50-year mortgage. So Trump is posting himself as a great American president alongside President Roosevelt. Nothing unusual so far here, but the 30-year mortgage tied to President Roosevelt in attempting to attribute a 50-year mortgage to himself. So this is where the idea came. I think the suggestion was from FHFA and Pulte, as I read it. There's scuttle that the White House is a little frustrated with Bill Pulte, more than a little frustrated after the weekend when this trial balloon was floated, because the response hasn't been great. It's more indebtedness to the American citizen, a sign of the death of an empire, as Ray Dalio has described, based on the increasing credit capacity of an empire like the United States. So you've got a lot of negative stuff coming along here with this. But Lance, there's been a lot of discussion over the weekend, and we're excited to just give some of our opinion on this. And we will link this in the show notes, a nice 11-point thread from Lance Lambert, who we mentioned at the beginning of the podcast, puts out a lot of really good content through Resi Club and a great Twitter or X account to follow. He was holding the real estate conference we were hoping to attend last week, but weren't able to at the last second. So anyway, it'll provide a good guide for us here to kind of talk about each of the points that are coming through, Jeff.
Yeah, absolutely. And so as we shift and look into it, when I first saw this, Mark, the idea of this 50-year mortgage, I thought, okay, that's interesting. How does it compare to a 30-year mortgage? So I asked Grok to run a kind of a parallel scenario between a 30 and a 50-year mortgage, using current interest rates. But one of the errors I made, which is illustrated in this slide, was not accounting for the fact that the shorter term mortgages have a lower interest rate. The 15-year mortgage has always had a lower mortgage rate than the 30-year mortgage. Now, the 50-year mortgage is kind of a hypothetical offering in the moment, but part of the X thread that Lance puts out is suggesting, kind of how much more that interest rate would be, in the neighborhood of 0.43 to 0.58%, or somewhere in that ballpark, right? So, the current mortgage rate today at 6.3, give or take, would be high sixes, on this 50-year mortgage. It was just interesting to look at historically what that spread has been. Right now, today's 30-year mortgage rate is 6.22%. The 15-year mortgage interest rate is 5.5%. And so, when I ran my initial scenario, there wasn't that much of a savings in the monthly payment. When you factor an even higher interest rate on a 50-year mortgage, then the impact goes down, even less as far as how much, what the impact is on the monthly payments.
Yeah, I think that's an important note that, this idea is to lower the monthly payment. That is the critical feature. It's trying to make the monthly payment more affordable to a prospective home buyer. And I think a lot of folks, like the lay people that are looking at this really quickly, are not considering that half a point higher, or half a percent higher in interest rate here. And this is a really good illustration of a hypothetical mortgage principal and interest payment difference on a $400,000 mortgage. So for a 15-year, that would be about $3,300 for those that can't see the visual on the screen. And that's assuming about a 5.5% interest rate. On a 30-year fixed at a estimated 6.22% interest rate, it's about $2,400. So $3,200 on a 15-year, $2,400 on a 30-year, and then it drops down to $2,300 on a 50-year fixed, assuming a 6.64% interest rate. So, I certainly less than 10% savings, Jeff, I think is the way to think about that on a $400,000 mortgage.
Yeah, and I think this is striking at the heart of why this has not been well received, and probably why Pulte is not, in great standing with the White House, because it's not being well received. Is the payment difference from the 15-year mortgage to the 30-year mortgage is pretty significant. From 3268 to 2455, it is a pretty material difference of over $700 a month in savings. That matters to people as far as qualifying for a mortgage or not. But from the 30-year mortgage at $2,455 a month payment to $2,297, roughly $150 savings, on a monthly mortgage payment basis, it moves the needle far less. And so that's kind of at the heart of where a lot of the lackluster response has been to this, idea of the 50-year mortgage. Is if it saved you another $700 in your monthly payment, I think you would have people, lining up to do it, because, very few are going to hold it through the 50-year life anyway. At some point, it's going to get refinanced. You can always pay more in principal pay down than just the minimum payments, all of those sorts of things. But it just does not move the needle very much in terms of the monthly payment. Part of it's because of the way that amortization schedules work. Part of it is also a factor of just simply having a higher interest rate spread over 50 years, as opposed to, the 30 or the 15-year options.
Yeah, and Jeff, to extend the argument against these things, are that, in this $400,000 mortgage example, the 30-year borrower over the life of the loan, $400,000, would roughly pay $483,000 of interest throughout the life of that loan. When it goes to 50, it basically doubles. It is closer to $980,000 of interest paid over the 50-year life cycle. It's an age-old argument here, and I think generally this financial vehicle has helped people get into houses. And controlling your mortgage payment over a long period of time and locking it in is worth the extra interest. And there are plenty of unquote financial experts that will say, look, inflation is such that this is a hell of a deal. Lock in your loan rate now, borrow this money at this 6% rate. And so provided inflation keeps rising at the 3% rate that it always does, you're making out, really, really good here, despite the large interest paid.
Yeah, that's exactly right. Yeah, and so I think one thing we can shift and look at just a little bit too is, I think the likelihood of somebody, paying a mortgage through the end of the 30 years or a 50-year is not super high. You end up, selling. It was probably more common, in the past to buy the house you were going to raise your kids in and then retire in and that sort of thing. People have had a little bit more of a desire for mobility and have refinanced when interest rates have gotten better. One of the slides that Lance put together was, saying, okay, so we've got this 15, 30, and 50-year scenario on this hypothetical $400,000 mortgage. Well, what does your equity position look like at the 10 years into this mortgage, right? And so with the 15-year mortgage, you're 10 years of the 15 years, you'd expect to have a strong equity position, and you would. His scenario is a $421,000 purchase price, financing $400,000. At the end of 10 years, you would have $321,000 in equity on a 15-year mortgage. On the 30-year mortgage, you'd have just a little under half of that, $156,000 of equity or principal pay down. And then on the 50-year mortgage, you'd have $106,000. So you're basically $50,000 less in equity on the 50-year mortgage than it would be on the 30-year mortgage. Just interesting to visualize how it breaks down that way.
Yeah, Jeff, I think this graphic is great. So the listeners that can see it, I think it's really helpful to see what they accidentally labeled on this chart noted on this chart, but isn't labeled, is I think really the important point and what the suggestion of a 50-year mortgage is. The 50-year mortgage is not competing with a 30-year mortgage and someone's just deciding which one is better for them. The 50-year mortgage is attempting to be offered to someone that is totally out of the housing market at a 30-year loan, right? It just doesn't work for them. So what I think the real comparisons here should be is the yellow line showing 106,000 of equity built up on the 50-year loan with the faint x-axis line of zero equity, which is the renter's equity built up. That is the group that this 50-year mortgage is pointed towards, those that just have no home ownership at all. And so would you rather have zero over 10 years or 100,000? Well, you're building a nest egg there. I mean, it could be better. Everyone would like it to be better, but it's certainly better than what you would do without any home ownership.
Yeah, I think that's a really good point. You're exactly right. That's not specifically labeled on this chart, but if that is the alternative, and always has been defined as part of the American dream, is being able to own some, real estate and build equity and wealth in that over time. And so it's a better option than nothing if nothing is the alternative to the 50-year mortgage. If your income increases, if circumstances change and you can work on paying, more than just the minimum, principal and interest payments, obviously you can build wealth more quickly. You're not locked into only paying the minimum payments and that sort of thing. But even if that's all you did, for the first 10 years, you're $106,000 better off than you would have been if you had only rented, like you say. So, to the extent that it's the avenue or the gateway to get somebody into home ownership that it wouldn't be, I can certainly see that making sense. I think anybody who would qualify for the 30-year mortgage is likely to look at that and say, I think that makes more sense given the incremental change in the monthly payment. But if they're right on the verge and can't, it's the difference between qualifying or not, it may still be better off. It'll be interesting to see how many end up being able or wanting to take that option, but it's another option on the table, regardless of the adoption of it, I guess.
And there are plenty of people that get into a 30-year and kind of quote unquote upgrade to a 15-year at the time they're able to for whatever reasons, and the same things could be offered here. a little history lesson, Jeff. This is another great example of what the podcast is doing to me in what were not predictable ways. A little history in the Japanese housing market. So as it turns out, we actually covered a couple of episodes ago, little secret that we did, covered the Japanese economy a couple of weeks ago on the podcast, but their economy was booming for a really, really long time. And then they had a lot of problems. And in response to all of that, they put together 100-year mortgage. I don't know if you knew that. I didn't until we started covering this a little bit here, but it is a 100-year mortgage, higher interest rates, maybe 2% or more higher because of the long-term risk that's perceived by the banks or actually experienced. And it is assumable. So I think the terms the Japanese used back at the time was grandparent to grandchild. So the mortgage was assumable by parents taking it out, their grandkid or their kids, and then their kids, right? And so it could go on down the list and lock in payments. I think it has ultimately been compared to an interest-only loan. Essentially the same thing is how it's all viewed. And banks don't really offer it anymore, except in like kind of rare cases, one way or another. But tools like this, I mean, they are not a sign of a healthy credit perspective or environment. So I am very much anti-credit on a lot of levels, certainly in my personal life. So I'm not proposing this, but we got real problems that we got to figure out how on earth we're going to get out of. So I'm not sure if this sticks. I'm not sure if anybody would use it, Jeff, but I do think that they serve purposes.
They do. Yeah. And, not every tool is right for every job, and this may be one of those tools that just isn't needed, all that often. It's interesting to think about the potential impact on the real estate market, on home values and pricing. And my perspective is, if the government's approach is to prop up the current price levels, it'll probably have that effect of propping up the current price levels. The alternative, as we've talked about a bunch, is either incomes go up significantly, home prices come down significantly, interest rates come down significantly, or a more moderated, combination of any of those three things. Providing another mortgage option that extends the term out, basically makes it a little easier to afford things at the current price level. It doesn't really address the underlying kind of misalignment with the economic price point of homes compared to people's incomes based on the current mortgage options and structures that are out there. And so I'm not calling for a housing, significant drop in pricing. That would be one of the natural market responses to fixing the lack of affordability, is you just end up having buyers able and willing to pay less than today's prices, for those. If interest rates stay relatively stable from a historical perspective in the sixes is not an out of line, it's kind of a reversion to the mean type of an interest rate. If you look back over a 30-year time horizon or something, incomes have a gradual increase, but they don't tend to spike up drastically. Home pricing, if you look at like the last 20 years, has been the thing that's moved, as much as interest rates, and could move again. Those that own assets don't want the values of the assets to go down. I mean, I certainly understand that motive, but unless there's broad adoption of this 50-year mortgage to kind of prop values where they are, there could be some additional pressures, and softening in the residential housing market. We're seeing kind of mixed signals there. I mean, as an appraiser, you always get people asking, what's the market doing, right? And it's not always that easy of a question to answer. But on average, I think the values aren't going up anymore. And in some markets, and especially in some segments of markets, they've softened, and that may continue if these kinds of solutions, being brought forward don't move the needle as far as, home pricing.
We got a real housing affordability problem, Jeff. That is the sickness. And I am not really sure that there can be much of an expectation to fix it in the near term without something unpredictable happening to interest rates. I think Trump would like something unpredictable to happen to interest rates next year. I don't know if that would happen, and or devastating price depreciation that would occur, and that creates its own set of problems. So we're going to need more tools to at least address the symptoms of the sickness that this affordability problem is creating. You know, as we look at the 50-year mortgage, how many people that are taking out a 50-year mortgage are actually doing this, Jeff? But there is an analysis that is being done on the social webs out there that is investing the savings, the $200 a month in that $400,000 mortgage example, into whatever, mutual funds. I saw someone saying, oh, well, just put it into Bitcoin. It's going up 20% a year for the next 20 years. And you're going to be a millionaire with that savings that you had from the $250 a month. I'm not sure a 20% compounding annual growth rate is what we should be assuming in our investment thesis, but in how many people actually do these sorts of things in principle. I see it's like a very popular thing online to see someone happy about paying off their mortgage, and it brings in the entire internet that calls that person that has resolved a debt as the dumbest person in the world that clearly can't do math because they had an asset of a low interest rate mortgage and could have just kept it, invested all of that money. I think it's a lot more complicated than that, and there's a lot of security and safety in de-risking that is part of that analysis. People don't consider there. I am in favor of paying off a mortgage. So internet trolls, come on, let me know that you hate what I'm saying there. But yeah, I not a lot of people will do it, but you could do something with the savings that might return more than 6 or 7%, and then you're in maybe a net worth position that was better than not taking a mortgage out at all.
Yeah, that makes sense. The alternative, yeah, and the kind of, at least as a point in your favor, Mark, of just paying the thing off, is if you then earmark whatever your mortgage payment is or has been and start investing that, you've got a lot of funds to invest without the debt service that you have on the mortgage. Now that's, that starts once you pay the mortgage off. It's not like you're able to do that over the life of the mortgage. I get that. There are interesting arguments on either side, but there's a certain level of kind of safety and value. I don't know many people that have paid it off and then regretted it and saying, well, crap, I want to run out and borrow a bunch more money against it again. It's an accomplishment that once you've made, some will for various reasons for sure, but on just on the principle or just for the sake of it, I don't see people changing course once they've gotten there either.
Yeah. So these 50-year mortgages, like you said, we were talking before the show started that this is essentially a interest-only loan for all intents and purposes. The 50-year loan is essentially an interest-only loan because you pay so little of the principal down in the beginning, in the long beginning of the loan cycle. But interest-only usually has a near-term balloon, so you lose optionality of keeping the monthly payment locked in that you have for a long period of time, and so these things are unpredictable. Except if the Fed is going to be printing money at the rate they have been, we're going to be in a home price appreciation cycle. But if you are in a home price depreciation cycle, this isn't a great thing to be a part of.
It is. And it's really hard to know what the cycle, predicting the future is not an easy thing to predict, but you do make a really good point. Mark, you'll look back and be glad that you did it if prices go up from where they are. If they soften from where they are today, you'll look back and regret it because you'll be underwater much quicker than those on the 30 or 15-year, mortgage cycles. So that's an interesting aspect as well.
I would imagine, Jeff, that a not talked about reality of the suggestion of a 50-year mortgage is that there is no way that there isn't a sizable down payment requirement. And, having the cash for down payment is one of 5 major problems with those 40-year-olds waiting 11 more years to buy a house, is who's got the cash to do that in this economy, And so because the bank's not going to let anybody get into these loans underwater. So, I think that's an important point that isn't talked about much here, and maybe makes them not very usable. And, you've got your loan officer friend, I think, that already has access to an extended loan period, and it's just not used.
Yeah, exactly. In fact, I had a conversation with him, but then I also looked it up on or did some AI research. It was interesting. They said, yeah, they don't even publish an interest rate for a 40-year mortgage, which is a debt instrument you can get today, but it's not even widely published because it's so infrequently used. I just don't see how the 50-year mortgage is likely to be more utilized than the 40-year mortgage, which, in theory has the same, general effect, just not spread over quite as long of a term. But, my friend was saying he's never once done a 40-year mortgage in his 20 plus years of originating loans. For the reason we talked about, it just doesn't pencil. And so it all kind of, culminates in, this slide that, Resi Club did, just polling people out there, like, how do you view this 50-year mortgage option? It may be a decent option for some, but 66% had a very unfavorable view of the 50-year mortgage. Another 16% had a somewhat unfavorable view. So you're over 80% of the people polled have very or somewhat unfavorable views of these. Somewhat favorable 11%, very favorable 7%. And I think it kind of breaks down along the lines of what we've been talking about, Mark, is for those who it's the difference between getting into a home and not. Maybe you've got a favorable outlook of this as at least an option to get there and start the home ownership process. But for the vast majority, it's not all that appealing of an option.
Yeah, you bet. Well, Jeff, I think that the end analysis here is that there hasn't been a real strong response. I think Trump maybe wishes that he wouldn't have put that meme out, not because he called himself a great American president, of course, but because the 50-year mortgage maybe is not landing like he wanted. But they're not done. I mean, they're thinking on what they can do. And one of the things that Bill Pulte has been talking about this week is looking into the possibility of making loans portable. So that is different than assumable. So an assumable mortgage is a mortgage that is on 123 Main Street that a homeowner has. They look to sell their home. That buyer can take on the loan that seller has, and then they become the signer on the loan. A portable mortgage really makes that loan an asset, right? I've got this 2% mortgage on 123 Main Street, but I want to move to 456 Jones Road, and I can take that $200,000 loan at 2% interest rate with me for the life of the loan. What an asset there. And I think that has people moving. I mean, they would need to borrow for the remainder of the difference between the price of the home and what their assumable or portable mortgage is. But I'm intrigued about that too.
Yeah, it really is an interesting concept. And actually, for anybody who's not an appraisal nerd, like, there are some classical calculations you have to learn in general appraisal education and then taking, tests to get certified that say, hey, if I got a mortgage that's, X% below the market, what's the cash equivalent price for that? It does have an implication in terms of the pricing you'd pay, as well as, on market values. Because if I'm getting a better than market interest rate for whatever reason, whether it's seller financing or because I've got this portable loan that I can just keep my 2% interest rate with me, I'm naturally going to be a little less price sensitive than if I've got to borrow the full amount at the predominant rates, 6.2 today for a 30-year fixed mortgage or whatever it happens to be at the time. So, it does have a really interesting, component. Now, historically, it's been harder to get these loans to be assumable or portable, but it's another option. As we talked about tools in the tool belt, it's another option to maybe make home ownership a little bit easier. I do think instituting portability would have a much more dramatic effect on just unlocking the housing market, because you're locked in at a lower interest rate than they are today. I am as well. I would be more interested in looking at making a change if I could port that current mortgage rate and mortgage amount with me to a new property. I think you'd see more transactions come as a result of that than you would now I've got a 50-year borrowing option that doesn't look all that appealing on its face.
It'd be a real game changer, I think, in terms of unstucking the mortgage market and the housing market generally. The last thing that is being talked about right now is that Fannie is following Freddie Mac's footsteps at FHFA's guidance to remove the minimum credit score threshold of 620. I think this is getting a lot of headlines as reckless and a sign that we are right back to the great financial crisis set of loose lending dynamics. As I look at it, I just wanted to bring it up, Jeff, because I'm not really sure. That's not my view of it. I think adding credit risk optionality. I think this is in keeping with Bill Pulte's earlier suggestion that previously renters and paying on time has not been allowed to be given credit in a borrower's application to buy a home, and their position was that it certainly should. And I think this minimum threshold is in keeping with that. A lot of folks in rural communities are unable to build good credit scores. I don't understand exactly why, but it just is a reality. Those that have little credit, so the 30-year-old that can't buy a house these days, or renters, all have a bunch of history that previously they've not really gotten much financial credit worthiness credit for. So, I think this is probably much to do about nothing, although we need to be careful, right? There should be no intention to make bad loans just because no loans are taking place.
Yeah, I think that really well sums it up, Mark. If there are alternative qualifications that are kind of replacing the FICO score, great. If it's just removing the FICO score and there's not an alternative measure of their credit worthiness, yeah, bigger problem. And I think the analysis is it's not just the removal of the FICO score, but it's an alternative, basically qualification, approach to these. But I think everybody who's lived through the great financial crisis, the spidey senses start to tingle a little bit when you look at just simply dumbing down or simplifying the credit process without protections in place to make sure that somebody can pay a mortgage. Now, somebody can get hit by a bus or things can happen where you may default just in the natural course of things on a loan, but that's far different from systematically making riskier loans and not pricing them accordingly. So I think I'm reading it the same way you are.
All right, Jeff, we are, I think, nearing the end, but let me try on. I don't even know if I can say this right in my head, but I'm going to try on a 4-dimensional chess strategy from the Trump administration we know he wants rates lower come hell or high water, and he is not getting that. And, I think he's going to get his own Treasury or his own Fed chairman in there sometimes next year. Maybe he gets something. I don't know, but he's got to get the economy moving. So, we have this tariff situation that we've been following for a year now. I think the United States, we've talked about the incredible surpluses that we've seen in the federal budget, which is cool. But it's largely, $700 billion or $1 trillion of tariffs paid in, right, that are creating that surplus. So you've got all that money coming in from decisions that the Supreme Court is now considering as possibly an abuse of executive power. We certainly don't want abuses of executive power. And there have been a lot of Supreme Court justices that have kind of indirectly opined that it seems like an abuse in how it's been implemented. So they are meeting soon. I don't know the exact date, but they're meeting soon. Knowing that and reading the tea leaves that there is some negativity towards the tariffs, Trump then and Scott Bessent are now out saying, we are going to refund tariffs to all U.S. citizens making less than $100,000 a year. So they are spending those tariffs and giving them to the public. The Supreme Court then comes in and says, not only were the tariffs not allowed the way you did them, you've got to give the money back. The money is already given to the taxpayer. The government's got to print money to do both of those things, pay the taxpayer and pay people back for the tariff that we charged illegally. And now imports have gotten way less expensive, which is hugely deflationary, causing home interest rates to drop materially from the Fed action. Do you follow all that? What do you think?
It really strikes on this visualization of so many currents, like flowing together. Now, the one thing I hear you say that makes me wonder if there's an offset to the deflationary effect of lower import prices is printing a bunch of money to pay for everything, right? And are the import prices really lower if they're just back to what they were pre-tariff? Essentially, we're printing money to pay the tariffs to ourselves, which seems a little bit circular, if I'm following that correctly. And boy, I'm not that great at chess or checkers, so 4D chess, it might be blowing my mind a little bit, Mark, but it's definitely interesting to see the posturing, based on the response from the federal government or from the Supreme Court. These guys are trying to make the strongest case they can for the tariffs, to not pull them back and provide incentives not to do so, right? So I get where they're coming from. What the net effect will be on prices and on inflation, I'm interested to see. I don't know if I see a compelling case for it to be radically deflationary, but we don't even have inflation numbers being printed at the moment. I think we're nearing the end of the government shutdown. We'll start to get some data that coming back in that we have been used to having on an ongoing basis. But I think that'll give us a little bit more clarity as to what's happening in terms of jobs, in terms of inflation, and that sort of thing. But I don't know. What's your read, Mark? Do you think it has that net effect, or?
I don't know. I struggle. I mean, clearly it's printing, $1.7 trillion, which I'm not sure is that much different than they'll plan to do anyway. Sadly, I mean, it's an embarrassment that's the reality that we're in. But I definitely think that a expectation of global free trade returning would be deflationary. I mean, it has certainly increased prices on some level, and so it may be a momentary effect, but it would, and probably give enough fodder to lower the Fed funds rate. And I wonder if quantitative tightening could counteract. Usually, it's printing a lot of money and quantitative easing, which is, just like two levers towards inflation. I wonder how those two can be used against one another to kind of accomplish certain goals. So I don't know. I mean, this is way over my head. I probably am too amateur at it all to even be guessing. But I don't know where all this money's coming from. And I at least feel like Trump put that out to make it painful for the Supreme Court to say no. I definitely think that. I don't know. So here we are. We as the world turns, the daily soap opera that you and I are following.
Boy, that's exactly right. Well, and you do just see these, these, efforts and then counter efforts, and we've witnessed a lot of that with the government shutdown. Obviously one side blaming the other and the other side blaming, the one side. And so I think with Trump, trying to get what he's wanting, as a result of these policies is doing the same thing, trying to posture and set things up to make it difficult to unwind tariffs or anything like that. So, it'll play out. It's interesting to follow and to try to digest and understand as best we can. So it's always fun conversation, trying to analyze this stuff with you.
Well, Jeff, from the hobby element of this podcast and the study that it's leading you and I towards, the podcast we did a couple of weeks ago on this credit creation theory and the printing of money or creation of money from banks making these sorts of loans and affecting home prices that are leading to problems that we have here. It's just, it all is really interesting. It's an interesting picture that is painted in a deeper study of home prices, what makes them tick. And from a valuer's perspective, I think this is a study that not many get into. It's much more macro, and I'm enjoying it.
Yeah, likewise. I am too. You see what you see from an appraiser or valuer's perspective in the micro, looking at, comparable sales of a specific property in a specific neighborhood. But there are a lot of these macro currents that ultimately impact what the price levels are at the very micro level. So, the where those currents cross, it's really fun to try to study and understand better than we do. And I think most would argue we still don't understand it very well, which I would, probably agree with. But it certainly causes, a deeper level of digging than we would be doing otherwise. So to that end, it's certainly valuable.
Well, enjoyed as always, Jeff. Look forward to episode 66. Until next time.
Very good. We'll see you then, Mark.